Hello again. I recently decided to close out my portfolio of sector ETF poor man's covered call trades at Merrill-Lynch. The main reason was that I'm moving the money in the Merrill-Lynch account to TD Ameritrade, which has the Thinkorswim platform, which I'm really happy with. So I'm glad I did that. However, having traded the poor man's covered call for about 4 months, I realized that I'm really not performing that well. Here's a graph that compares my portfolio, the blue curve, to a virtual portfolio of all S&P index fund SPY in red versus a 60-40 SPY bond ETF mix with the gold curve. So I'm falling behind the far lower risk 60-40 portfolio. I seem to have about the same volatility as the SPY portfolio, but I'm just not or maybe worse, and I'm not keeping up with it in terms of returns. So I thought it'd be useful to go through many of my positions in the Merrill-Lynch account, as well as my Robinhood account, just to see how I'm performing, how the poor man's covered call is doing. There's no substitute for actual results. You can talk theory all you want, but this is what matters. Okay, so in all these graphs, the blue curve is the change in the share price, the actual share price. The gold is the change in the price of my leap option, while the red is the performance of my position. So each time I sell a call, the P&L rises, and when I buy that call back, the P&L falls. So you get sort of a sawtooth pattern on the red curve. It's hard to get a real feel for the performance of the position at any one time because you collect a credit for selling the covered call, so your P&L goes up, but you have a liability sitting on the books. So to kind of get a sense of what's really going on, I like to connect the troughs and peaks of the red sawtooth curve to get upper and lower bounds on the performance. So a realistic view of the performance is kind of the midpoint between these two dashed red curves. So this green curve that I've drawn here. So in this case, which is on the Vanguard European Stock ETF, or VGK, I'm up about 15%, while the share price is flat. So the poor man's covered call has done well here. So to give you, to remind you of my strategy, which is a fairly mechanical strategy, which I use for all these trades. I buy the 80 Delta Leap, about 120 days to expiration. I roll that leap out in time when it gets to less than 60 days to expiration. I sell at the money covered calls with about 30 days to expiration against the leap. And I roll that covered call whenever the delta rises above 75, if it falls below 35, or I get to less than 10 days to expiration. So I'm not trying to time the market. This is a purely mechanical strategy. Okay, so here's the FXI, which is the Chinese stock ETF. It's been a real roller coaster. I haven't gotten an edge here. This is the common weakness of the poor man's covered call. When the ups and downs happen too quickly, you're always behind the curve. So when the stock falls, you rush to sell covered call before it falls any further. Then the stock roars back and your covered call is suddenly deep in the money and you have to buy it back. So the poor man's covered call works much better when the moves are more gradual. So here's TLT, the 30-year Treasury bond ETF. The leap has lost a lot of value, but I've been able to hedge with the poor man's covered call, and I'm about even. Here's XLB, the basic materials ETF, another roller coaster. I was able to track it nicely when it was rising, but when it dropped rapidly and rose rapidly, I was basically keeping even with the leap. So I'm ahead of the share price itself, but I don't really have an edge here over the leap itself. Here's XLC, which is the Communication Services ETF. The share price fell steadily, and I was able to hedge with the poor man's covered call, but I'm still just tracking the share price at this point. Here's XLE, the energy ETF, which rose steadily over this period. I was able to capture about half the gains of the leap with the poor man's covered call. So this makes sense since the position's about 30 to 40 net delta. XLI is a stock that's worked pretty well with the poor man's covered call. The leap price fell for the most part, but I was able to gain an edge by selling covered calls. The share price was mainly flat, so presumably the leap was losing value due to time decay or a drop in implied volatility. I'm up about 15% while the share price is even. Here's XLK, the technology ETF. I'm basically breaking even with the poor man's covered call. It's about the same as the share price, but better than owning the leap alone. Here's XLY, the consumer discretionary ETF. It's worked very well. The share price was mainly flat, but the premiums collected on the covered calls were sufficient to give me an edge. So lately the stock price went up fast, so the leap rose strongly in price, but I've kept up with it. I'm up about 40% over this 2-month period. So now we can look at some stocks from my other portfolio at Robinhood, where I'm also trading the poor man's covered call. This is the SPY, which is the S&P index fund. It actually updated last Friday, November 5th, 2021. So for most of the time, the SPY has risen in price, and lately it's spiked upward strongly. So I'm capturing about 30% of those gains, which is to be expected on a steady rise since I'm net 30 delta with this position, and I'm ahead of the share price alone. Here's GLD, which is the gold ETF. Over this time period, the share price was mainly flat. The leap lost about 35%, but I was basically down about 10% with the poor man's covered call. So I've hedged a lot of the losses on the leap. All right, so in conclusion, I went over some actual examples of trading a mechanical poor man's covered call strategy. So to remind you, I typically buy 80 delta leaps with 120 days to expiration and roll at 60. I sell 50 delta calls against that leap with 30 days to expiration. I roll the call, if the covered call, if the delta goes below 35, above 75, or I get to less than 10 days expiration. So this mechanical strategy does well when the share price rises or falls steadily or stays flat. It does poorly when the share price rises or falls rapidly. So in other words, it does poorly when the realized volatility of the share price is larger than the implied volatility, which governs the price of the calls that you sold against it beforehand. So going forward, I'm aiming for a less mechanical approach. As before, I'm going to aggressively sell covered calls if the share price falls or stays flat. However, when the stock is coming out of a rut, I need to let it ride on the way up and don't sell calls against it. So this is obviously easier said than done, but it's what I'm aiming to do. And see if we can figure out, when the stock is bottomed, rather than just mechanically selling covered calls, let that thing ride up and at least gain the upside. The poor man's covered call does a good job of kind of hedging downside moves, but the biggest weakness is that you lose a lot of upside. And so anyway, let me know what you think, and we'll see you next time.